Do you like that?
It's very nice.
I do too. I think it's almost perfect for what we're going to talk about.
Very nice.
Economics.
I feel just relaxed.
In rhythm.
It's rhythm sequence. No, it's wonderful.
That's fine. Hey, thank you, Cole. That was lovely.
Yes.
Yeah.
Nice intro.
Yeah. So that's a great way to introduce Terry Liebman. And
thank you.
He is my guest. Thank you for coming to the Golden Com podcast.
My pleasure.
Right on. So this weekend, one thing on a podcast, you got to get your mouth right in there.
Oh, right in there. Okay.
Right
got to be
there.
closer.
Got to be closer.
All right.
And we don't need to be closer, but we got to be close to the mic.
Understood.
So Terry, you've been a friend, coach, advisor of many people. I'm one of those people. Always enjoy your insight, and I could not help but this weekend to call you. I wish the circumstance would have been different, but we had a bank closure.
Yes.
And when a bank closure happens, I'm sure there's lots of news about it. And so I said, why don't you come on? I've been meaning to have you on here for, since we opened. And I really want to talk to you about economics in ways that you put context around economics.
Okay.
And I also want to shout out to a tool that you use to communicate on a weekly basis. Mm-hmm. And I thought we would just have a conversation about that. And that will also lead into how banks close,
Absolutely.
Which is what happened this weekend. But before we talk about what banks close, talk to me about the Steakhouse Index.
Okay. The Steakhouse Index was born about 5 or 6 years ago when I found that because I study economics and economic activity and the direction of the economy, and I make investment decisions based on that, I found that a lot of information that I was getting through the typical sources was lagging. It was always behind the curve. And so I found that if I'm trying to predict economic activity and the level of gross domestic product, that I would get data 3 months, 6 months late. And so the opportunity to make an investment decision ahead of time was gone. It was behind me. So I started looking at alternative data, alternative metrics. And I came up with the idea that, when I go to an expensive steakhouse, if it's full, clearly the people that are at that steakhouse are feeling economically flush. They've got money in their bank account, or they've got a credit card that hasn't been burned up yet, and they're willing to spend money. But when times are tough, those same people won't always go out and the restaurants are emptier. So the theory was, how the Steakhouse Index was born, is that when people are feeling good and spending money, then that indicates that the economy is on a good trend and that economic activity is high, and that means that investment growth is possible. But if steakhouses are empty, that indicates that in the aggregate, people aren't spending money, and it indicates that the wealthiest quartile or percentage of people are not spending money, and that suggests that the economy might tail off. So the Steakhouse Index is simply an alternative data metric that measures reservations for expensive steakhouses once a week on Wednesdays at 11 a.m. The same 40 steakhouses across the country in 10 different cities. The same 40 restaurants at 11 a.m. on a Wednesday, and I track it every single Wednesday, except unless when I'm skiing or not in town. And then I produce a graphic that shows the activity over time. And by watching that trend, I can then decide if the economy is static, growing, shrinking, and it gives me the data and the insight that I need to make the decisions that I want to make.
Let me see if I can repeat back what I heard.
Okay.
The standard data that we all see that gets put out, whether it's job report or whether it's inflation, or seems to take a while to get to us laymen's, or anybody for that matter, because there's so much data that has to be gathered.
It's not just that there's so much data. It's usually they're just reporting on what happened in the past.
Yep. You have developed a tool on what's going to happen tomorrow night.
Right.
Yeah.
Actually, on Wednesday, what's going to happen on Saturday?
That's right. So you get an idea.
Yeah, exactly.
In a very practical way of saying how many people are buying very expensive steaks.
Exactly. Yeah. Exactly.
By city.
Exactly.
Okay.
In 4 restaurants in 10 different cities,
Yes.
40 restaurants in total. Yes.
Okay. So what I want to do, Cole, can put up that's right. So this is your website here.
Right.
And it's a great place. And you don't just do steakhouses. You're doing all sorts of home costs. You're doing all sorts of analysis here. But where you find the steakhouse index, is it in S? Where do I find
SHI.
SHI?
Yeah.
Where do I find the last graphic that you did on the steaks? Where is that?
Just pick any one. The last one would be the one at the top. Just
Right here?
Click on snail tracks.
Click on snail tracks.
Yeah,
Got
click
it.
on snail tracks. And then just scroll down.
Scroll down.
Yeah.
And then we're going to go scroll down.
keep going.
Scroll down.
Keep going.
Scroll. Oh, here we go.
There you go.
This is the guy I'm looking for.
Yep.
So I'm going to click on him, open tab, a new image, and I'm going to go over here, and I'm going to blow this up.
Okay.
Okay. So what you're saying here is you've got these are the markets on the left.
Correct.
Yep. So the OC, San Francisco, Dallas, Chicago, St. Louis, New York, Boston, Atlanta, Las Vegas. That's a pretty good sample.
Yeah.
Right?
Covers the entire country.
That's right. And then the second column are your different restaurants.
Correct.
So some common themes in here. I see some chains in here.
Yeah, yeah. Well, there are a couple of chains, and I did that intentionally because I wanted to see, for example, Mastro's is a common theme. I really should have Mastro's as an advertiser. Mastro's is a common theme because it's a very expensive restaurant.
Yes.
If you go to Mastro's, if 4 people, and by the way, this is measuring reservation demand for tables for 4.
Okay.
That's the metric.
That's the metric.
If 4 people go to Mastro's for dinner, they're going to spend $800 easy, maybe $1,000 for dinner. Dinner.
I can verify that.
Yeah, you both can.
Yeah, ouch.
So you spend that kind of money, you must be feeling pretty good about the economy. And these X's show that those are open tables at those particular time slots in those particular restaurants. If it's blue, that shows that it's full. So that Mastro's in the Orange County that shows 5:45, 6, 6:15, 6:30, et cetera, that restaurant was full that coming Saturday when I measured it Wednesday at 11 a.m.
Okay. It's Wednesday at 11 a.m.
Yep.
I want to eat at Mastro's in Orange County. 5, I better know the manager.
You better.
Because
you're not getting a reservation. No.
It's full.
It's full. For this coming Saturday, you're not getting a reservation.
And if I want to take a nap, I can eat at Ruth's Chris at 8:45 is my first chance.
That's your first chance Saturday night.
On a Wednesday.
Wednesday afternoon, Wednesday morning when I checked.
Okay, what does 63 mean? That's on the right.
So the maximum SHI Steakhouse Index number is 72. So if every restaurant was booked, all 4 restaurants were booked at all time slots, the algorithm I've created would give you a 72.
Got it.
Okay. The one below it is a -3. That means that quite a few restaurants were available. And I've got a kind of a value-weighted algorithm that I wrote, meaning that if 7 p.m. is the most common reservation time, that most people want to go to dinner, but they've also booked 9 p.m. If 9 p.m. is fully booked, 9 p.m. is worth like 1.5 of 7.
Right.
So it's kind of a time-weighted metric that goes into the algorithm.
You should be full at 7.
7, you should be full. There should be very few tables available at 7.
There should not be full at 9.
It should not be full.
You should not.
You should be sleeping at 9.
Right. And at 5:45, that's pretty early on Saturday.
It's ridiculously early.
Yeah.
Yeah.
Okay. So, let's just do some spot checks on here. So, San Francisco. Okay, I'm going to go back so I can see the whole thing. San Francisco, you got 2 in the red here. You've got San Francisco, a red 3, and
St. Louis.
what is going on in St. Louis?
I couldn't tell you. It's funny. I've been doing this, as I said, for about 6 years.
Yeah.
Pre-pandemic, St. Louis was pretty typical. I mean, it would ebb and flow. The reservation demand for the coming Saturday would go up and down. Since the pandemic, it's like people are staying indoors in St. Louis. I couldn't tell you why the restaurant reservations in St. Louis tend to be very, very weak. It's bizarre.
Well, note to self, if I'm in St. Louis, don't worry about making a reservation.
And it's funny, because of the Steakhouse Index, when I travel now, I tend to try the restaurants that are always booked. Like there's a restaurant, if you zoom into Boston, there's a restaurant called Moo.
Moo?
Moo.
Okay.
So Moo is the last restaurant in Boston. I've been tracking Moo for years. It's in Beacon Hill in Boston.
There's Moo.
And I found myself in Boston last October.
Right there.
And said to my wife, hey, we got to go to Moo.
You can't.
I mean, no, I made reservations before we went, 2 months ahead of time.
Yeah.
And because I'm curious, why is this place always booked? So I went to Moo, and it was wonderful. I mean, the restaurant was beautifully designed. The wait staff was impeccable. The food was spectacular. The wine list was amazing. I mean, you felt like you had a wonderful experience there. And I can see why they're always booked. Rarely do you find a reservation at Moo, unless you make it a month or two ahead of time.
Yeah. So I'm not getting trends out of this. You know, if I could follow you and start making my own trends. But can you give me a nickel tour of the trends that are happening?
Well, the trends are in a different chart.
Okay.
So what I do is this is just the data.
Yep.
And then I take the data and compile it on a trend chart, which is the next chart in the same.
So here.
Yeah.
I go back to your website.
Scroll down. There you go.
There's your trends.
Yep. There are the trends.
Yep. This was not the easiest thing for me to read.
Yeah.
Okay. I tried to read it. So what are the trends here?
Okay. So what this is a week by week.
Starting at 4/6/2022.
Yeah, I changed that at times. I've got this data going back again 6 years. But
okay.
This is a week by week comparison. The only way you can compare data is side by side.
Okay.
It's kind of like 2 glasses of wine, right? You can only compare wine side by side. So if you scroll to the right, kind of slide to the right, you can see that the weeks, this is week by week, that the numbers appear. And it's kind of interesting because you can see the trend lines in different cities as you go across. So the negative numbers there, that's all St. Louis. Yeah, I mean, they had a pretty good showing in September of last year, but they're just constantly negative. It's interesting. But some of the other cities, like if you look at Orange County at the top, they're always in the high 60s and sometimes 72, which is the peak.
72 is the peak to Valentine's Day.
Yeah, Valentine's Day. So every single restaurant was booked.
Even St. Louis made it.
Yeah, even St. Louis kicked up on Valentine's Day.
People even like love in St. Louis.
They love steaks on Love Day. Exactly.
Good.
Exactly.
Oh, this is awesome. Okay, well, this is a great trigger point for me. Yeah. So, and I've subscribed to this, not just for this, but also the other insights that you give.
Cool.
So if you don't mind, let's talk about some other insights.
You bet.
So I watched a movie. There's 2 movies that come to mind, but I watched The Big Short this weekend.
Great film.
It was from the Lewis guy.
Michael Lewis.
Yeah, also Moneyball, same guy.
Yeah,
great
Moneyball.
researcher.
Oh, great.
Great author.
Yeah.
So
I think the first book he wrote was Liar's Poker. I love that book.
Yeah. So I watched it because this banking news is, of course, hopefully not going to be the same magnitude as we had in The Big Short, but I watched it and it just reminded me how banks can fail.
Right.
And this last episode seems more like another movie that you told me. What was the other movie?
It's a Wonderful Life.
Jimmy Stewart.
Yeah.
And what was the mean boss's name?
Potter. Mr. Potter.
Mr. Potter. And Jimmy Stewart, who took over his dad's business.
I think it was called a thrift and loan back then.
Yes.
Yeah.
And there was a bank run.
There was a bank run.
Spawned by?
I think some money disappeared and accidentally his cousin stuck it in a newspaper. I don't remember all the details, but all of a sudden people got nervous and they showed up at the front door and they said, I want my money. Give me my money. And then people noticed other people standing in line, and pretty soon everybody in town went into the bank, thrift and loan, and said, I want my money.
Right.
The problem is the money's not there. As we all know, a bank doesn't pile up bricks of $100 bills in the back. They invest it. They invest it in home loans. So like in It's a Wonderful Life, Jimmy Stewart finally, when he's got the crowd, he says, hey, the money's not here. It's in, Billy, it's in your house. And Jimmy, it's in your barn. And he's going around telling people that we take your money and we hold your money in safe places, but we invest it in mortgages and we invest it in treasuries. We invest it in safe investments. And those investments have duration, sometimes 10, 20, 30 years. The problem is that if someone wants their money, usually they can give them back the money for a few people,
Right.
but they can't give back the money for everybody.
Not all at once.
Not all at once.
No. And that is called a bank run.
It's a bank run.
So a bank run has to be the two of the worst words put together a banker could ever hear.
You bet.
A bank run.
Yeah.
And so this weekend, or on Friday, there was a bank run spawned by, I want to say spawned by fear.
Mm-hmm. Yeah.
And just, fear that something was wrong.
Sure.
And that in fear causes more fear. Fear loves fear.
Oh, yeah. Yeah. Feeds on itself.
Feeds on it.
Oh, yeah.
And they had a bank run. So the bank up in the Silicon Valley, what the hell happened?
Well, it's interesting. It kind of all began with a massive spike in deposits that they had back in 2000. So their deposit base went, call it from 80 billion to 200 billion over about a year.
Okay, slow down for me.
Okay.
Deposits mean people putting money in the bank.
People put their money in the bank because they want to bank there.
Okay, so I've got a lot of money, and I know there's a lot of investors and capital. So they're like, well, we got to put it somewhere.
Got to put it somewhere.
We raised a bunch of money.
Raised a bunch of money.
So
we got a bunch of pandemic money. There was just a ton of cash. And by the way, this isn't unique to them. This is all banks.
Right.
Yeah.
But if I had a bunch of money in the Silicon Valley, it seems like Silicon Valley Bank would be a logical place for it.
Absolutely.
Plus, it's got a pretty prestigious board of directors, been in business a long time. Okay, so you get influx of cash.
So a lot of cash goes in. So the bank all of a sudden says, we've got a lot of cash. What do we do with it?
We can't have a bunch of $100 bills in the back.
That doesn't work.
Nope.
And it also doesn't get us any kind of a yield to pay our depositors on savings accounts or whatever. So part of it they loaned out. They would loan it out to people.
Okay.
But they still had a lot of cash. And
Right.
so they invested a lot of it in U.S. Treasuries.
That sounds incredibly safe to me.
U.S. Treasuries are incredibly safe. In fact, in theory, it's the safest investment on the planet.
So this bank, which had all this cash, loaned some out so John can
Sure.
get a line of credit, or this person can do some factoring, this person might want to buy a building, but they can't make all those transactions. So what we'll do is we will buy U.S. Treasuries,
Right.
which sounds like almost the safest place to put your money. Doesn't sound very profitable, but sounds very safe.
Very safe.
Okay.
But
Well, there's a but.
there's always a but.
Okay. What happened?
U.S. Treasuries range in duration from as short as a week to as long as 30 years. So when you buy Treasuries, it's not homogenized. They're not all the same. So because short-term Treasuries are due very short and long-term are very long, usually over longer periods of time, you get yield increases.
What do you mean they're due?
So when you lend money to the U.S. Treasury, the due date is when they have to pay it back to you.
That's the due date.
Yes.
Okay.
So they give you back your money. So you can buy U.S. Treasury for a week.
Yes.
And then in a week, they'll give you back your cash.
That's when it's due back
Yes.
to me.
Yeah.
The opposite of when I think something's due.
Correct.
Like my mortgage payment.
Well, it is because in that case, you're the borrower and the bank's the lender. In this
Right.
case, you're the lender and the Treasury's the borrower.
Okay.
So it's the same thing.
So I can do a
just
30-day treasury note.
Yeah, yeah, sure.
Oh.
Yeah. 30 days, 60 days, 90 days?
And they have to take it if I loan it to them?
No. They do an auction, I think, every Thursday.
Okay.
And so the U.S. government, as you know, spends a lot of money.
Yeah.
They need a lot of money. So they do auctions every week.
Got it.
So when they auction these things off, they've got different durations that they auction. So that's in the primary market. In the secondary market, there are a lot of them resold. But regardless, you can buy a duration on a treasury, pretty much any duration you want,
Okay.
literally. The bank, knowing that short-term durations, a week or a month, were like a yield of 0.25%, they said, oh, but the 10-year treasuries, they're 1.5%. So they bought a lot of 10-year treasuries.
Because they had so much money.
They had so much money, they had to put it somewhere.
That 1.5% sounds okay.
Well, 1.5% seems super high because for the last 10 years, between 2010 and 2020, interest rates were close to zero.
Right.
So this is right around the time of the pandemic. 1.5% seemed pretty high. So they bought these things. They bought a lot of them.
It sounds safe.
Super safe.
The most safe.
Safest investment you
It
can
sounds almost the antithesis of greed.
make. Yes.
Okay, so they buy all of these treasuries at 1.5.
So they got, and let's say they bought $1,000 of treasuries and is paying 1.5%.
Okay.
And they stick them on their balance sheet, and the Treasury pays them every 6 months. They pay them interest, And that's it. They're done. It just
Okay.
sits there. Then the Federal Reserve, to tamp down inflation, starts raising interest rates at the fastest rate of increase that they've ever done. In 1 year, they raise rates about 5%. And as a result, the value of that treasury, which was a 10-year treasury at 1.5%, dropped because interest rates went up. And someone could buy a 10-year treasury 1 year into the Fed rate increases with a 4% return, or they could buy this one for a 1.5% return, and they'd buy the 4% because it's a better deal. So the value of the one that the bank held went down. And that reduction in value, it's called impairment. That impairment is reflected on the bank's balance sheet as a loss. That loss was kind of unnoticed until...
Even though it's not a loss yet.
Yeah, and by the way, it never will be, because if they hold that bond for 10 years...
They get it back.
They get 100% back.
Plus 1.5%.
Correct. Yeah. However, if you try to sell it in the middle, you'll sell it at a lower price, which is what the bank did. They sold $21 billion of Treasury securities, and they lost, current value, lost $1.8 billion. And so they said, okay, we'll raise more money. We'll do a stock offering. And they made that public announcement literally a few days after Silvergate Capital Bank failed, the crypto
The
bank.
crypto bank.
And all of a sudden, investors got nervous. And that was it.
Because
That was
they
the spark.
announced they were going to raise money.
Correct. And if they're raising money, they
And
must
then
need money. If
someone
they
might-
need money, I can't leave my money there, so I better go to the bank and get my money.
Bank run.
Bank run.
Oh, man.
Yeah. Yeah, that was on a Wednesday. On Thursday, this is an interesting statistic. The bank had $200 billion of assets. On Thursday, they got withdrawal requests from depositors for $42 billion.
Oh, my gosh.
One day.
Oh, my God. News travels fast.
Oh, in Silicon Valley with iPhones, it travels really
it travels
fast.
fast. Now, also, most people, I think, have been paying attention to interest rates. But when you say 5%, that doesn't sound like a big number. Since 5%, it can go up to 100%. But 5 points. But what percentage increase is that? That's more than 100%.
Huge.
Yeah, so it's 5 points
Correct.
that went up, not 5%.
Right. It went from about 1% or 1.5% up to about 5%.
Up to 5%.
Yeah.
So that's like a 400%
It's
increase.
massive. And it happened in a very short period
in a very
of time
short time.
historically. Yeah.
Yeah, just clarifying that.
Yeah.
Wow. So, I don't want to tell you that, my knee-jerk reaction when I hear something like this is, oh, those bankers, those guys were greedy, and now they're. It just doesn't seem the case. It just seems like they were playing it safe. The Feds did something that maybe somebody might think they should have predicted, but certainly not at that rate. And then they got in the wind of a bad timing. Probably shouldn't have announced any panic.
Right.
That's probably what did it.
Yeah, it was a series of unfortunate events
Yeah.
that just kind of lined up.
Jeez.
Yeah, just bad timing. And because of the Fed's recent rate increases and their just push on this situation when rates had been so low for so long, it just creates this opportunity for these kinds of things to break. And this was a snap. They were pushing, and this particular bank happened to be in the wrong place at the wrong time, and snap, just broke.
Okay. So this is not 2009.
Oh, quite the opposite. No, 2009 was a very, very different problem and much more systemic. This is a real issue. There are a number of other banks that have a similar impairment on their balance sheets, but they
better be very, very quiet. I don't mean to laugh. I don't want to laugh at
Don't
someone's
tell
expense.
anybody.
Yeah, I don't want to laugh. So.
But unfortunately, it's so true, right? If this is kind of swept under the rug,
Yeah.
it's only when it becomes known. But the problem today is now everyone's looking for it. So you looked at the stock market today, and a lot of the banks were crushed by the fact that all of a sudden People are bringing out magnifying glasses.
Oh, sure.
And looking for these kinds of potential problems.
Makes perfect sense.
Sure, that's what people do.
Yep. Well, Terry, thanks for coming. I thought to myself, I'm just going to wait the weekend and listen and I read the million articles on this thing, or I'll just call Terry and he'll come in and explain it to me. So I really appreciate you coming.
My pleasure.
In.
Thanks
Have
for
you in
having
again
me.
sometime. Is that all right?
I'd love to.
All right. Thanks,
Thank you.
Terry. Yeah. Well done.
Thanks.